Great. Well, thank you, Tara. Welcome, everybody. Thank you for joining us today. For this Florida tax update, we just want to touch on a few things that we see come up, areas where we see a lot of questions and concerns that from our clients over the last year or so. So our presenters today are Stacy Roberts. She's a senior tax manager or senior salt manager in our Denver office. Laura Robichaud is a senior salt manager in our Phoenix office. And I'm Jennifer Edwards. I'm a manager in our Sioux Falls office, also with the SALT group. So just the things we want to talk about today, we're going to start with just doing a quick overview on doing business and NEXUS, an overview on those. Registering a business in Florida, when do you need to do that? What steps need to be taken? Laura then was going to talk about sales tax. She will talk a little bit more about sales tax NEXUS, the various business transaction taxes imposed by Florida, the types of taxable transactions, sourcing rules for sales tax purposes, and then also some sales and use tax incentives. And then she'll finish up her section by talking about a recent ruling that can have an impact from a sales and use tax perspective. Stacy will then move into a discussion on Florida income tax. She'll delve even further into income tax NEXUS and doing business in Florida. She'll also talk about the corporate tax regime, filing methods and apportionment, and then briefly talk about pass-through entity filing requirements and then Florida residency. I'll then just wrap up quickly with just a little bit of what to do if your business has decided to dissolve or withdraw from the state of Florida. So doing business, just quickly a NEXUS overview. All states, NEXUS is the connection that's needed in order for a state to be able to impose their tax laws on a business. So in most cases, when we think of NEXUS on the sales and use tax side, we think of physical presence. And still currently, physical presence is the general standard for sales and use tax purposes throughout the country. And physical presence, that is just what it sounds like, having an office in the state, or employees or independent contractors doing business activities in the state, having inventory in the state. Basically anything where you would have a real presence within that state. Somebody actually crosses into the state would be physical presence. As states and commerce have changed, states are looking for other ways to broaden the sales tax base, ways that they can pull in more remote sellers, make them be taxable in their state, or be able to have those entities collect tax from their customers in their state. We've seen more states pass or adopt a click-through NEXUS, an affiliate NEXUS. Both of those types of NEXUS are really created by when an out-of-state entity receives sales that are referred by another business or another entity that is physically or has a presence in the state. And we've also seen in recent years economic NEXUS. Now we've seen that on the income tax side, but we're now starting to see that on the sales tax side too. And under the economic NEXUS rules that have been, that states have passed, even though currently none are being enforced, but some states have passed them, there is no physical presence required. Most of those laws have been based on a threshold or so to speak, where it is based on a set level of number of transactions or a set amount of a threshold of gross receipts within the state. For example, in South Dakota, my state, we're one of the first states to pass an economic NEXUS, and the thresholds on that were 200 or more separate transactions, or $100,000 or more of gross receipts from the sale of tangible personal property or services delivered to customers in South Dakota. So those are the thresholds, and if an out-of-state entity would have met either of those thresholds, that would then they would then have had economic nexus. However, as I said, that's not currently being enforced. Legal action was taken against the state. It's moved through the court system in South Dakota and actually was heard by the U.S. Supreme Court in April, and we expect a ruling in June on that. But that's still we'll have to see how that changes, and that could change much of these alternative nexus standards. But currently, Florida has not adopted any of these alternative nexus standards. So right now, physical presence is still the standard. And then when it comes to income tax, again, we've got physical presence, economic nexus. Basically, many states, most all states have adopted some form of economic nexus. They don't all define it the same way, however. But generally speaking, would be if an entity is if a business is creating a gain or creating a benefit from the state, then they would be considered to have economic nexus. And then some states that have economic nexus have even gone a step farther and adopted a factor-based nexus, where they would have, if they meet a certain threshold, and the general rule is $50,000 in payroll, $50,000 in property, or $500,000 in sales. If they have exceeded that, then they would have created established nexus. Florida does follow an economic presence income tax nexus standard, but they have not gone as far as the factor-based. So the Florida corporate income tax is imposed on all out-of-state corporations for the privilege of doing business or gaining income from Florida. So how do they define doing business? Because as I said, many states define it somewhat differently, but some similarities. But Florida defines it as actively engaging in any transaction for financial gain. So if an entity has income gained from or attributed to sources in Florida, including income from tangible or intangible property located within the state, and income from any activities carried on in Florida. So that is how they define the doing business. But Stacey will talk more about the income tax nexus standards. So registering a business in Florida. So who needs to be registered? So if your business will have any taxable transactions in the state, you must register. And then I'm first going to talk this really geared more towards in-state, those entities that have a physical presence in the state, not the remote sellers initially. So if you're selling any transaction, any taxable transactions, you must register as a sales and use tax dealer before beginning conducting any business in the state. Also, if you rent or lease real property or personal property, if you rent any type of short-term living or sleeping arrangements, charge admissions to various types of venues, have manufacturing or sell service warranty contracts, even operating a vending or amusement machine. Those are all types of activity in the state that would require the business to register with the Department of Revenue. So for an out-of-state business, it'd be somewhat similar. Again, if they're soliciting sales of taxable services or any of the taxable, selling any taxable tangible personal property, having independent contractors going into the state, doing anything, even any kind of mail orders, catalog orders, advertising materials in the state, there would be a requirement to be registered. So when we talk about the types of products that would be taxable, just your general taxable or tangible personal property would be the things you think of: computers, pre-written computer software, appliances, machinery, furniture, even homemade products if you're selling them, soaps, candles. Those would be considered selling taxable tangible property and would require the entity to register with the Department of Revenue. Although most services are not taxable in Florida, they do specifically identify some taxable services, such as detective and other protection services, fingerprinting services, non-residential cleaning services, non-residential building pest control services. So those types of services are taxable and would, again, require registration with the Department of Revenue. So once an entity or a business has determined that, yep, they probably will have met that threshold, they'll be selling tangible property or services in the state. They're going to have people in the state. They're going to open up an office in the state. So what steps do they need to do? Well, from a registering of a in-state business, one step would be to register with the Department of State. Now, registering with the Department of State, that is getting the authorization to transact business in the state. A lot of times the decision to register and the actually registering with the Department of State is done by the legal counsel or the legal representatives of the entity. But that is something to keep in mind if it is a foreign corporation, meaning a corporation incorporated outside of Florida, but will be having a presence in doing business in Florida, they would need to file an application for authorization to transact business. Along with that, that form is also there's a $70 filing fee to get registered. If it's a Florida corporation that's going to be incorporated, they would just file their articles of incorporation and pay that $70 fee to the Department of State, and then they would be registered. But once registered with the Department of State, there is an annual filing that is required. And it's an annual report that's due every year between January 1st and May 1st. And that report has to be submitted along with a $150 annual report fee. And if that is not filed by May 1st, there's a stiff penalty of a $400 late fee that is charged on annual reports that are filed after May 1st. And another issue, to be registered with the Department of State, you also need to appoint a registered agent in the state. So in addition to that, then so if we're registered with the Secretary of the Department of State, but what we're really focusing on for this presentation would be being registered with the Florida Department of Revenue. And when you register with the Florida Department of Revenue, there's various taxes that you register through them with one application. And the application, the business tax application, is form DR-1. Once that application is accepted, the entity would receive a certificate of registration, and that would show that they are registered with the state and are in compliance and eligible to conduct business in the state of Florida. On that application, the different tax types that you can register for are sales and use tax, the discretionary sales surtax, reemployment tax, communications services tax, the stamp tax, really depending upon the type of business or the type of products that you sell may determine which types of tax you need to register for. In addition, if you have employees in the state, you'd also want to get registered with the Division of Workers' Compensation. And as far as an out-of-state business, before they even start doing business in the state, they'd want to just determine whether or not they should be registered. So if an out-of-state entity has employees that come into the state, maybe not on a regular basis, they may not be residents, but they do travel into the state, or independent contractors that conduct any type of sales or other business activities on behalf of the entity in Florida. If they maintain any type of place of business, maybe it's even a temporary, even maybe they do have an employee or that has a home office, that could be enough that they would need to register. If they're coming into the state to assemble or install service or repair products, they would or need to register. Also delivering goods to Florida customers in their own company trucks or leased trucks, they would have to register with the Department of Revenue. So Again, the process really is the same whether you are an out-of-state business or an in-state. It is, again, the form DR-1, and the various tax types can be applied for on that form. So one thing I just want to leave with you as I wrap up this part is that when starting to or thinking about maybe expanding a business into Florida, or starting to, whether physically moving into the state or starting to, if you have customers in the state, before you start doing business in the state or even making sales to Florida customers, it's really important to understand the applicable taxes and the implications within the state, so that you can get in compliance and then stay in compliance going forward. So with that, will take us to our first polling question. Okay, so our first polling question is, when is an out-of-state business required to be registered with the Florida Department of Revenue? Oops, I think we have a little typo there. If they have employees, agents, or independent contractors conducting sales in Florida, service or repair products in Florida, provide taxable services in Florida, or all of the above. Great, that is the correct answer, all of the above. So thank you, and with that, I will turn it over to Laura to talk more about sales tax.
Thanks, Jennifer. I hope everybody can hear me okay. I don't think in any of our webinars we've ever had 100% on a polling question, so I think that's a new first for us, so that's awesome. So my name's Laura Robichaux. I live in beautiful Phoenix, and what I'm going to talk to you today is about some nuances as related to sales tax. Now, a lot of companies, especially the way companies do business nowadays, is it's very rare to find any type of entity that is only operating in one state. The majority of what's happening is we're seeing a shift in business models to where you're operating obviously in multi-states, and then we've seen a huge increase in companies that are going global, for example, doing business in Mexico or Canada or the AU or the EU. So Florida, which happens to be very much a transient state like Arizona, and I'm not going to spend too much time on the NEXUS because Jennifer did a great job explaining some of this, but Florida is not only unlike any other state that has NEXUS requirements. I mean, anytime you send a salesperson, if you're a contractor or you do any sort of machinery and equipment, and perhaps you're doing some repair service on your M&E, any activity where you're physically in the bounds of Florida could potentially create a sales tax nexus issue. One of the things that we look at in our firm is, you know, what's the frequency of this? Okay, so you had someone come in one time. Does that really warrant going out and getting a sales tax license application and filling out all those forms Jennifer went through? Probably not. But if you find that, you know, maybe last year you went in once or twice, and then in this current year you're going into the state more and more, then that is when you need to start paying attention and talking to your accountant advisor on maybe we need to file in this state, not just for sales tax, but also for corporate tax too. So this is just a list, and again, this is not a full comprehensive list, just the main ones. And the big one for a lot of machinery and equipment companies is delivering products into the state. So if you don't have your own trucks, but you're using a third-party truck to go into the state, you know, some states say, okay, if you have a third party, you automatically have NEXUS. Florida's kind of on the fence about that. I would say it's something that if that's a regular course of business for you, you can feel free to reach out to us, because that might trigger NEXUS for sales tax reasons. Okay, so Florida has some really weird taxes, and they call them different things. So one of the ones that's probably going to stick out the most is everybody for the most part, will know what use tax is. But they have this thing called discretionary sales surtax. And if you're not familiar with Florida or have never gone to Florida to purchase anything, this discretionary sales tax is very similar to the California district tax. It is a sales tax that is kind of piggyback to your sales tax, your actual sales tax for the state, county, and city, but it's an additional tax. So one of the things that you may not realize is you do an order in Florida and you Google what the sales tax rate is. Well, probably your Google search is probably not going to pick up that additional discretionary surtax. So you either need to have some sort of automation, or you use a system that will calculate it for you that picks up that add tax. So that's just one thing to kind of be aware of. Florida, because they are a transient tourist type of place, they also have additional rental taxes. So this comes into play for entities that own property that maybe rent out that property. That could be commercial, probably more residential, but it definitely could be commercial. Anything less than a period where about 30 days or less, short-term leases is going to trigger a transient rental tax. If you go anything longer than that, it actually triggers a different type of tax. They also have certain special districts. So they have, if you're doing any type of development, there's a lot of sports authorities down there. So there's going to be a sports franchise tax, and usually those are zoned out, and you would have to be inside the zone to trigger that type of tax. So if you're a builder and you're working on commercial projects, or you're delivering material to those potential areas, you might be subject to that tax. So the reason I kind of wanted to list everything is just to give you an idea of, it's not just sales tax. They have all these additional taxes. So what's taxable? This is normal with like other states. If you're a contractor, you're paying tax and material at the point of purchase. If you're leasing equipment, that's going to be taxable. Services aren't usually taxable, like Jennifer had mentioned. There are some weird rules around admission. One of the court cases I'm going to go over that was pretty interesting is, maybe they didn't charge tax at the beginning for something that was not taxable, but there was a sourcing issue. So we're going to talk about sourcing too. But for some reason, anything that has to do with amusement is going to also be taxable in Florida. So there's not anything unusual here, other than I would be really cautious around any type of rentals or leases specific to real property, or even heavy machinery and equipment. Okay, sourcing. If I were to go online, and I was to buy something from, let's say, somebody's website, it's the system that I pull it out from is automatically going to calculate a sales tax rate for me, and I'm going to ship it to Florida. What a lot of companies don't realize, and this is where the Florida auditors start drooling, is they find out that, I bought something and I shipped it to Florida. Well, the sales tax rate on my ship to location was inaccurate. And this comes up a lot. So there's this thing in sales tax, and we've talked about it in some of our webinars. It's called destination versus origin-based sourcing. Anytime I say sourcing, people automatically think, well, Laura, that's corporate tax. Not really. It's also sales tax related, but different. So destination means that you're going to have to charge sales tax, and you're going to have to make sure that the software you're using, for if you're doing any online orders, or if you're a contractor and you do job orders through your website for your vendors, that it's hopefully collecting the right sales tax rate. So destination is, where is the ship to address? What is that tax rate for that location? It has nothing to do with the ship from. And where we see a lot of issues is, what's a ship from state? Origin. Arizona's an origin-based state. So, we look at sales tax from, where am I shipping it from? Florida, and a lot of the other states look at it as where you're shipping it to. They look at it by county, they look at it by city, local municipality. So that's one thing to be really careful of. And a lot of companies aren't aware of this, is there's only about 13 states that are origin-based. Everybody else is destination. So if you're shipping to a lot of different places, I would really encourage you to check to see if you are shipping to an origin or a destination-based state, because that can make a huge difference in a half a percentage or even a percentage. So each state can change this every time they go into session. Usually it's once a year if for some reason they want to change from being origin to destination, which is what we're seeing. That's why there's not a lot of states that are origin-based anymore. Everybody's moving to destination-based because it actually pushes more money into the coffers of the local municipalities. Just be careful on which one you're shipping to in Florida, and you need to drill down to those local levels because it really does make a difference. And you could be looking at a tax rate of maybe 10%, but there's probably 4 levels of taxes in there that are built into that 10% rate. One of the ways that we've seen, especially and we suggest for companies that are growing and anticipate growth over the next 5 to 6 years, is if you have an opportunity to automate your processes, it's only going to make your life easier. What we see is a lot of companies that, they were small, they're getting a little bit bigger, they're getting a little bit bigger, and then, you've now have 2 or 3 people that are completely bogged down with an administrative process a couple days a month to file these reports. There's tons of options to automate your software to get your sourcing correct, because nothing's worse than getting an audit letter from a state and they tell you, oh, you've been collecting the wrong tax rate, and by the way, there's 400 jurisdictions in Florida and you're liable for something in each of them. So there's tons of options out there if any of you are interested in what that might look like. Not only automation on your internal processes, but if you have an online presence and you allow your vendors to order online, there's companies out there that can help you, so that way when they order online, it's automatically assessing the right rate. And I can't tell you how many times in hindsight a company said, oh, I'm glad I did something with automation. It just helps in the long run. So it's not all doom and gloom with sales tax. There are quite a few incentives, and usually when you hear the word credit, you automatically think, corporate income tax credit, but surprisingly, Florida is one of the very few states that will actually add, we call them mirror credits. So there's a mirror credit for corporate income tax, and they'll have the same alike credit for on the sales tax side. And this is normal for most states, but usually it's a corporate credit. So if you are doing a sales tax project, and I'm not going to dig through each of these, but I kind of put them up here high level. If you wanted to, they're in great detail on the Florida website, and you can kind of look to see, like, maybe we qualify for this one, especially the industrial machinery and equipment. You might have a credit there. Who knows? So they're not huge, but if you do your research, there's probably, and you might fit in one of these buckets, it might be worth your time. So those are just a couple of them. If you really wanted to go to the website, you would kind of drill down into taxes, tax fees, or you could just search in their search box, sales tax incentives, and it will pull up for you. Okay. So I'm only going to go through 2 cases, and surprisingly, and if anyone's been through an audit, I feel your pain. Florida takes forever to do anything. The DirecTV, and I put the date is really important. So DirecTV was under audit in 2005, and their Supreme Court case went public, I believe it was in late 17. So just to give you an idea, that is how long it takes to get through the system. There's multiple layers of tax court levels that you can go through, and it just takes forever. So DirecTV and another company called EchoStar had tried to get a refund for their communication sales taxes that they had paid in Florida, and everybody knows who DirecTV is. But what they said is, DirecTV, for those of you that do have it, you can watch that stuff now on your phone. iPad, your kids are watching stuff that you DVR'd, whatever it is. DirecTV said, hey, this is interstate commerce. What if, my family, Laura's family went to, we're moving all over the place. Maybe we're not in one spot in Florida. Maybe we're in a different spot in Florida. How can we provide the correct tax? Because remember, they're a destination state. So it's kind of hard to do that when, technology, especially AI, has kind of thrown us into a new different world, and our tax rulings haven't caught up. So DirecTV said, we're exempt from this because this is interstate commerce. We can't control where people are going with our DirecTV. The Florida said no, and they denied their refund, pretty much stating that DirecTV was not in violation of the Commerce Clause or interstate commerce, and so they lost that refund. And Florida is not unique in the sense of other type of telecommunication companies have gone through the same process with other states. And what we see happening here is that the state language is not sophisticated enough to rule on the business activity, especially a telecommunications business activity. So therefore they're saying, well, it doesn't specifically violate anything, so you're denied your refund. This, in terms of Florida and telecommunications, which is a pretty large industry in of itself, it was kind of epic because, DirecTV was left saying, well, how are we supposed to charge sales tax on this? In what rate? And how would we do that? And there was not really any direction given from the state. So they came to an agreement of, okay, well, wherever the billing address is to, which you can consider your ship to address, let's go with that. And that's where they left it off. The second case that I actually thought was kind of interesting, and this also has to deal with sourcing, is there was a company, online provider, you go online, you order flowers for your mom or your dad for a holiday, and they grab that information and they push it out to a third party that's in Florida. Keep in mind, this American business was also in Florida, but they more operated as like a broker almost. So they pushed out the order to a local florist, whoever was closest to the address that, I wanted to deliver my mom's flowers to. And Florida said, what was happening, let me back up. What happened is that on any of the out-of-state orders they fulfilled, they weren't charging sales tax on. So I'll without giving you a visual, I'll try to paint this picture. The company's based in Florida. The person who orders it is in Florida, but they're shipping it to Jennifer in Sioux Falls, South Dakota. The American business wasn't charging sales tax because they view that as this is an out-of-state thing. We're shipping it out of state. Florida came back and said, they shook their finger at this company and said, nope, you have to charge sales tax. Now, they went as far as adding a specific thing in their statute specifically for florists that say, and I'm going to paraphrase this, so don't quote me because don't have all the legal language in front of me, but it pretty much said for florists, even though you're shipping it out of state, you are going to have to use your origin address for the sales tax. So now, and because this has kind of set precedents for other companies, even though you're shipping stuff out of state. So if you have a presence in Florida and you're shipping stuff out of Florida, maybe you're a florist, I don't know. You may want to look at if they have different rules, because this isn't the only industry. I just picked it because, flowers seemed kind of interesting at the time. But there are other rulings that happened that had to do with this same type of thing. It's an out-of-state sale, but you have to charge Florida tax based on your origin address, which is wherever your brick and mortar is or wherever you have your employee. So it was kind of, groundbreaking. I think this came out in 2016. I believe, maybe mid-16. So that's just something to keep in mind, is that it wasn't, just don't think if you're doing business in Florida, don't think just because it's out of state, there's no tax. There might be some other level that you might have to dig into. And if anybody has any questions, you can feel free to reach out to us and we can provide you with that information. But so that's kind of it for me. I know I've talked about flowers and DirecTV. I'm going to hand this over to Stacy, and she's going to go over the income tax portions for Florida.
Thanks, Laura, and hopefully everybody can hear me too. And unfortunately, we have some construction going on in my office, so you may hear some banging and some drilling. So I'm just going to apologize, and hopefully it's not too distracting for anybody on the call or for me. So with that, I'm just going to get started. And I'm going to talk about the income tax side. And I know that we've talked a lot about NEXUS and what are some NEXUS creating activities, but I guess I just wanted to also talk about it from an income tax perspective. And also, you know, if you've joined us for any of our other state presentations, I think we've said it before, but I'll say it again for Florida because the same thing applies, where Florida also defines doing business. And it's very broadly defined, and it means actively engaging in any transaction for financial gain. So what does that mean, right? And so they further discuss this in a rule or a regulation that says that you can have income gained, or your financial gain can be from income from tangible or intangible property that's located in Florida, and income from any activities carried on in Florida. So again, very broadly defined. So I don't want people to get or have some kind of misconception that just because you have, you don't have a physical presence in Florida, that you may not have income tax nexus. Although on these next few slides, you'll see that, they do provide some examples. And again, these are all in the regulation. And most of them are related to some type of physical presence in some way, shape, or form. But basically, they say anything from incorporating in Florida, having an office, having or owning or leasing tangible personal property, maintaining inventory for sale, having inventory on consignment, displaying a corporation's merchandise in a leased space on a recurring basis, or having agents or employees installing or repairing products in Florida. And again, I caution everybody that it doesn't necessarily have to be a W-2'd individual who would be in the state to create income tax nexus. It could just be an independent rep. Furthermore, a few other things that they post on this or in this regulation that are examples of nexus creating activities are having employees that accept orders in Florida, and some of these examples here, which we'll talk a little bit about Public Law 6272 in a minute, but some of these examples in these slides really are those types of activities that exceed the protections of Public Law 6272. So some things just at least to kind of keep in mind. And like I said, we'll talk a little bit more about what PL 6272 is if you don't know what that is. But some of these things on these next couple of slides are those things that exceed the protections, and employees accepting orders is one of those. Selling goods through mobile stores, so that's kind of interesting, right? We see even things such as food trucks running around. So don't forget about those kind of activities, and that having that mobile store being a physical presence in the state. Again, exceeding PL 6272 protection, those kind of activities. Having corporate officers who have a permanent or extended temporary residence, and they even have some, they put some numbers around this, 3 months out of a 12-month period, and who are making management decisions while in Florida. And then also selling or licensing the use of intangible property in Florida. A few more, conducting seminars, also having a franchisee and franchisor relationship. We see this, with some of our clients who they may have a franchise location and the franchisor is outside of Florida in this case, but a lot of times these franchisees are getting direction from the franchisor. There's a lot of processes that the franchisor is directing for the franchisees, and so having those kind of relationships also create nexus for income tax purposes. Having a financial company receiving interest from loans secured by real or tangible property that's in Florida, and then selling, managing, or providing consulting services for intangible assets may create nexus. Now, I find this one kind of interesting because there's this caveat here that does not include out-of-state corporations, and we'll talk about more why corporations is important here. that only manage out-of-state assets in the state. And they provide this example that if you've got a New York investment company that continues to manage investments for a Florida resident, that's not going to create Florida nexus because that's a limited connection. So, they do have a few things that they carve out, but for the most part, a lot of these are physical presence-based, like I said. And then don't forget about your professional sports teams. If you have a corporation, again, that's an important part for income taxation in Florida, but if you've got a corporation that has a professional sports team and they're, doing activities, having sporting events in the state, then that's going to create nexus for that corporation. Okay, so I mentioned Public Law 86-72, and again, this is an important concept. It applies in Florida too, and for those of you who don't know what it is or need a refresher, if you've got an employee or a sales representative that's going into Florida and all they're doing is soliciting sales of tangible personal property, and the orders are accepted and approved outside of Florida, and then the goods are shipped from outside of Florida into the state, then those are protected activities, and they would be protected from income tax. So that's alive and well. Florida has a net income-based tax, therefore Public Law 86-72 does apply. Again, I mentioned in those earlier slides that you could have a situation where you're exceeding those protections of Public Law 86-72, and therefore you could create nexus in the state. So you really have to be careful about what your sales representatives or employees are doing in Florida or any other state that has a net income-based tax, because you could very easily exceed those protections and therefore be subject to the income tax in the state. Okay, so Florida does provide, and again, this is not an all-exhaustive list, but they do provide some examples of activities that would not create nexus. So if you're maintaining a bank account or savings account in Florida, holding stock in a Florida corporation, having an independent Florida accountant, attorney, et cetera, that is maintaining books and records, or doing tax prep, that's not going to create nexus, which seems kind of obvious, but it's good to kind of see some of these things in writing or in a regulation where the state actually says, you know what, no, we don't think that that's nexus creating. Again, this goes back to Public Law 86-72, but having resident salespeople that are soliciting sales of TPP, and then if you have salespeople in the state that are maintaining samples to demonstrate or giving free samples, then that does not exceed Public Law 86-72. It starts to get dicey if those samples are sold. So if they're available for sale and are sold in the state, then you're exceeding protection there. And then providing company cars to salespeople in the state is that doesn't exceed Public Law 86-72 either. Okay. So, we went back. We went too far. Oh, no, we didn't. Sorry. Polling question. All right. So polling question number 2. Does the state of Florida follow Public Law 86-72? Or I'm sorry, the state of Florida does not follow Public Law 86-72. True or false? Do we have some results? All right. It's a little bit of a trick question, though, because it's in the negative, but it is false. They do follow Public Law 86-72. Okay. So now we're going to keep going on our corporate tax regime here and just kind of talk a little bit about computation here of the tax. So Florida defines net income as adjusted federal income or an apportioned share, depending upon if you're doing business in more than Florida. And then you'd have non-business plus non-business income that's allocated to Florida, less an exemption. That exemption is $50,000 currently. That the starting point on the corporate income tax return for Florida is line 30, so that's after NOL deduction and special deductions. You do calculate your own separate Florida NOL, however. There's a 5.5% tax rate. I'm going to skip over the IRC conformity for a minute because I've got a few more comments I want to make on that, but don't forget that Florida does have AMT. So if you're subject to AMT for Fed, you'll need to compute it for Florida as well. They are one of the few states that does have a separate state AMT calculation. The tax rate is at 3.3%, and then you're paying on the greater tax base. But I do want to comment on the IRC conformity, particularly because we know that we've got tax reform out there, and we're trying to track as best we can, based upon the information that we have, the states that are conforming or not conforming, and what's happening in that with that. And so Florida did put out some guidance at the end of April, where they have typically been an annual so they've typically had a rolling conformity to the IRC as of January 1. So that has not changed. So their current conformity is the IRC as amended and in effect on January 1st, 2018. So that means that they do conform to the tax reform, and where this is important is that, so for anybody who's wondering about what to do with 965, for example, there's no adjustment required for excluded repatriated income under 965. That also means that there's no inclusion of the repatriated income in the apportionment factor. So they are conforming to that part. So just, if anybody is interested in reading, there is a tax information publication that's out there where they did put out the information on what they conform to, and those are really the highlights. So I just want to make sure everybody's aware of that. They are one of the few that have put out information on the conformity. All right. So we're going to move to our next polling question. So what is the current corporate income tax rate for regular C Corp taxpayers in Florida? Is it 0, 5.5%, 6.5%, or 9.5%? That's right, majority got it right at 5.5%. Okay, moving right along. All right, so in an affiliated group environment, so if you've got an affiliated group of corporations filing a federal affiliated or consolidated return, you've got some options with Florida. Typically, as a default, Florida is a separate company filing. So if you've got, like I said, if you've got a consolidated group, you've got some affiliates, and you've got a couple of affiliates that are doing business in Florida, then they could each file separate company in the state. However, Florida does provide a consolidated return election. A couple of caveats on this, though. It is a binding election, so if you make this election, you would have to go to the Department of Revenue to ask for that election to be taken away. So once it's made, it's binding until you request for the department to allow separate company filing. Each member has to consent to the filing of the consolidated return. One of the other requirements is that the group has to file a federal consolidated return for the taxable year, and then it has to include the same group members that are part of the Fed in the Florida consolidated return. So something to keep in mind if you've got a group of corporations, and like I said, you could have a situation where you've got a few members of your consolidated group that are doing business in Florida, so maybe making a consolidated election may not be a bad idea. So we talked about, our starting point for the Florida return. Then we're going to talk a little bit about, okay, well, how do you determine, your Florida income? So Florida, from an apportionment perspective, they are one of the states that actually uses all three factors still. So they use the property payroll and sales, but the sales factor is double weighted. So basically you're taking property payroll plus 2 times your sales and dividing by 4. We see more opportunities or nuances with the sales factor. I'm not going to talk about the property or payroll factor, but a few things to keep in mind for the sales factor. Generally speaking, and this is not really that different from any other state, however, one little caveat, for tangible personal property, source to destination, great. And where I sometimes get some questions is, well, what about if we go, what about if we have the FOB terms are a certain way? Is that really still a Florida sale or another state sale? So what's interesting about if you were to read the, what is a sale for most states, it's source to destination, so in this case of Florida, regardless of FOB point, if that ultimate destination is Florida. So I don't want people to get hung up on the fact that you could have some FOB terms, which actually may impact sourcing for sales tax purposes, however, not necessarily for income tax. So just one thing to keep in mind. What's interesting about the sourcing rule for tangible personal property for Florida is that they don't care about the FOB point unless the shipment is made via common or contract carrier. So that's a little bit of a nuance with Florida that not every other state has. So you could have a situation where it could be shipped outside, or it could be outside of Florida, depending upon how it was shipped. So just something to keep in mind, again. They do have some special rules for NAICS number 311411, which some of you might be like, what is that? And that's actually for frozen fruit, juice, and vegetable manufacturing, which makes sense since Florida has a lot of produce. They do not have a throwback rule. Sales of services, Florida is one of the few states that is still based on cost of performance. If you've joined us or know anything about sourcing rules for services or sales of other than tangible personal property, most other states, there's a lot of states that have gone to market-based sourcing. Florida has not joined that bandwagon yet, so you're left to look at where's the greater proportion of the cost of performing the service, where is that occurring, and if that occurs in Florida, then Florida would want 100% of it. They would not want a proportion of it, they would want 100% of it. And then also one nuance with Florida is that cost performance includes costs paid to independent contractors, so it doesn't necessarily have to be limited to the costs paid to employees or W-2 individuals. Okay, quick note about pass-through entities. I noted that, for our NEXUS, they talked a lot about corporations. There's a lot of mention about corporations, and that's because generally speaking, there is no individual income tax in Florida. I think most everybody knows that, but what that also then means is that there's generally no filing requirement for our S-Corps and our partnerships. S-Corps would only pay and file Florida income tax if they're paying federal income tax, so if they're paying the big tax, those kind of things. But however, if you have a flow-through entity that has a corporate partner or member, then you have to make sure that you're including the apportionment, that the corporate partner is including the apportionment, any kind of Florida apportionment in their own return, because that corporate partner then would be subject to tax in Florida on their own by virtue of the fact that they have an interest in an entity doing business in Florida. Quick note about residency. We get some questions sometimes about, okay, well, Florida is a great place to live because there's no individual income tax. That might be true, and it's true for other reasons. It's a nice state to live and visit. However, something to keep in mind is that if you were moving from a state that had an individual income tax to Florida, your previous home state is going to fight you. And we get a lot of questions about this. And what Florida does provide, which is kind of nice, is what's called a homestead exemption, and it's a property tax exemption. and it reduces the value of the real property in Florida for Florida residents, and it reduces that real property value up to $25,000 for a single taxpayer, $50,000 for a married couple. And they have some factors, and these are all related to the homestead exemption, on how do you prove that you're a resident of Florida. And many of these are pretty common. You know, they would apply even if some, you know, I live and work in Colorado, and so these would be things that Colorado would look for too, to see whether you're a resident or not of our state. So, but what's interesting is that, you know, in order to get this homestead exemption, there's an application, and then they recommend getting this formal declaration in the county that the exemption is being sought, that that you are actually a resident and domiciled in Florida. So there's some other common factors that, like I said, apply to a lot of different jurisdictions as well. You know, voter registration, make sure that you're registered to vote in Florida as opposed to keeping your registration wherever you may have moved from. Same thing with driver's licenses. A lot of this is all about intent as well. You know, if you're intending to stay in Florida, you're not intending to come back to, you know, your previous state. You've got your doctors, you've got your kids are in school in Florida, et cetera. Those are all things that go a long way to show that, no, I'm a Florida resident and I have no intent on going back to my previous state. So just to, you know, a couple things to keep in mind. Like I said, we do see this a lot since Florida does not impose an individual income tax, and it's the same thing like in Nevada, Wyoming. So it's just important, if you feel that you want to move to Florida, that you go through certain steps to establish that residency so that your previous state does not try to fight it. And then with that, I'm going to turn it back to Jennifer for a few comments on closing a business in Florida.
But first, let's do that final polling question. Since it.
Oh, sorry about that, everybody. Okay, well, final polling question. Florida imposes which taxes on pass-through entities? A minimum tax, an annual filing fee, all of the above, or none of the above? Most everybody got that right. It's none of the above. They do not impose taxes on pass-through entities. All right, thanks everybody, and I'm going to pass it to Jennifer.
Thank you, Stacy. Yeah, I just want to make a couple quick closing statements about closing a business in Florida. So, if you've decided that maybe you're going to leave the state, move out of the state, no longer going to be doing business in the state of Florida, and that's the key piece. Is really no longer going to be doing business. If it's just a matter that you had an employee in the state, a resident employee, and now they're not going to, they've left the company or whatever, but you're still going to have business activity in the state, that does not constitute closing a business, or that you may not have filing requirements or may not still have NEXUS in the state. So what this is really meant, if you are really truly leaving the state, closing down your operations, dissolving or withdrawing from the state. So if you were registered with the Secretary of State, there is a corporate or LLC dissolution documents that would have to be filed. Along with that, there is a fee that needs to be paid to the Florida Department of State to close out with that entity. In addition, you'd want to notify your registered agent to let them know you're dissolving or withdrawing from Florida. But for all entities that were operating and doing business in Florida that had filing requirements, all applicable taxes are due within 15 days after the closing or the selling of a business. So what you want to make sure is that you file all final returns, mark them all final. Along with those returns, you need to remit all outstanding tax liabilities, including any interest or penalties. And that final return must cover the period from your most recent filing to the date of closing. So if you maybe have maybe 3-4 years worth of returns that had not been filed, you've got some outstanding returns, all those back returns would need to be filed all the returns from the last filing to the date of closing would have to be filed in order to officially close out your business within the state. Just again, wanted to keep that in mind. We do see from time to time when clients move out of a state or they no longer in a state, they just kind of stop filing. That's not, you need to take the steps to actually make sure the state is aware that you're no longer doing business in their state. So, all right, with that, I want to thank everybody for joining us today. I know we're running right up to the end. If there are any questions, please feel free to contact any Laura or Stacy or myself. Tara, can we open it up for questions or not at this point?